Good afternoon, everyone. Welcome to this week's Mortgage Minute. My name is Art Alvarez with MortgageWorks, where we have the answers and they're on the house, coming to you from the Greater Palm Springs and Coachella Valley area. Glad to be back live. You may have noticed last week we had a taped program because I was up in Monterey, California at the California Association of Realtors winter meetings. I may not have shared this on the program, but I'm actually a member of the Greater Palm Springs Realtors Association. In fact, I'm on the board of directors. I'm also the chairperson of the membership committee, actually co-chair of the membership committee now. And I'm also president-elect for the Greater Palm Springs Realtors for 2026, which means I'll be president of the association in 2027. So part of those positions require me to attend the CAR, the California Association of Realtors meetings, where I'm also a director there. Not that that's all that exclusive. There's, believe it or not, about 800 directors with CAR throughout the state of California. And that meeting process, actually, with that many directors, when I first heard about it, I thought, how do they get anything done? But in reality, the process is actually very efficient, and we're able to get a lot of business accomplished. So again, glad to be back. And then, of course, as I tend to do, touch on what's going on in the sports world, just if nothing else, for a little diversion from all the other news that sometimes isn't all that great going on right now. Jeff just put it up there. Yeah, we got the Super Bowl this weekend. And I will say again, go Seahawks. I'm gonna say that they're gonna win this Super Bowl. I've got a little bit of a bias. Their quarterback, Sam Darnold, he's a USC guy. My dad went to USC. He didn't play football there, but he went to SC, so I grew up in an SC household. In fact, I read an interesting article about Sam Darnold's grandfather. It turns out he was pretty accomplished, both in the sports world in terms of basketball and volleyball. It turns out he was also one of the Marlboro men in commercial advertising back in the 70s. So pretty interesting background there. And, of course, he was an SC guy, which, of course, that must be why Sam Darnold went to SC as well. And, then, of course, the other thing happening, I think, as of tonight, we got the start of the Winter Olympics. Always like to see that event. I get a lot of enjoyment out of watching that, the downhill skiing and the ice skating and the speed skating and so forth. So a lot going on sports world-wise starting this weekend. So, again, go Seahawks, and we'll see what happens with the game. We'll go ahead and go into what's going on in the mortgage and real estate market right now, or the bond market, I should say. We'll start with our rate grid. More of the same, broken record. Rates are still hanging in there. Yeah, we had a little bit of an elevation in bond yields here in the last week or so, but it's actually settled down, as we'll show you in a moment. You look at our rate grid on our website. We try to keep this posted to reflect current conditions. We're still well in the fives with just about everything. So, again, we seem to be really stuck in this level. I think that's a good thing. Rates are very stable at this point, and I think there's still a chance that they may trend downward, if not immediately, over the next several months. If you look at the bond chart, it tells an interesting story. There it is. This is, again, a 5-day chart going back to last Friday. And you can see last Friday, it was getting kind of elevated up in the 4.25 range. We had a nice little dip going into Monday, getting closer to 420. But then it kind of jumped up for the balance of the week, at least up until today. You can see, late Tuesday, we were hitting 430, which was a little bit of a concern. But right now, we're seeing a nice improvement down below 420. So that's a definitely good thing to see. Not exactly that downhill slope that we're going to see in the Winter Olympics. But again, finishing up the week under 420, I think, is a good thing. So what's going on in the financial markets and the bond market? This week is employment data week, or I should say was supposed to be employment data week. But we had a couple of issues. If you may recall, we had a second government shutdown. Now, it only lasted 4 days. But initially, early this week, when I actually prepared this material, it was indicated that we were going to have a delay in the JOLTS report, that's job opening and labor turnover report, as well as a delay in the U.S. employment report. That is to say, the unemployment rate. So beginning of the week, the indication was both of these reports are going to get delayed because of the second, I call it, government shutdown too. So then later in the week, we had yesterday the ADP employment report. Remember that that's jobs at a private level. It does not include any government jobs. And the ADP report came out with 22,000 actual new jobs. 45,000 was forecast. So that's obviously quite a bit lower than forecast. In fact, less than half of what was forecast. You might consider that a little bit of a concern, but ultimately it doesn't seem like the market has reacted to that much. In addition, we had initial claims come out today. 212,000 was forecast. 209,000 was the previous number, the previous week. Well, as it turns out, that number came out stronger than expected, 231 forecast. Of course, the media immediately grabs onto that and says it's a surge of unemployment claims. But I will remind you, it was only 2 months ago we were at the 231,000 level, if not actually a little bit higher than that. So I don't know that that's really cause for concern, given the fact that we were at this level not long ago. So I think overall, despite the fact I know Amazon has announced a good amount of layoffs, overall the economy does not seem to be showing any significant weakening in the labor market. Which, of course, if that were to happen, that would tend to improve bond yields because, again, a poor economy tends to be good for the mortgage business, mortgage rates. But right now, things seem to be holding up pretty well. Again, I mentioned the U.S. unemployment rate. It was due out tomorrow. It's forecast to be unchanged at 4.4%. However, when I looked at the U.S. economic calendar today, just before we went live, I noticed that report is off the calendar entirely for tomorrow. So it looks like we're not going to get an updated unemployment rate report tomorrow as was originally scheduled. That must have something to do with the government shutdown. And then lastly, I want to comment really quick on, you may have heard our President Trump has announced his nominee to replace Jerome Powell as Fed chairperson. He nominated a person, last name of Warsh. What does that mean for mortgage rates? Well, a couple of things. I read up a little bit about this particular nominee. Interesting guy, a pretty impressive resume. Apparently, he was involved in the Fed system, the Fed governor, when he was 35 years old, youngest ever. Apparently, he has, in recent times, been a little bit more in the camp of believing that we could do more in terms of lowering rates. And a couple of things I noticed in terms of the articles about him is that he's actually given speeches where he suggested that there needs to be a regime change as it relates to the Federal Reserve. And he, in fact, specifically accuses the Federal Reserve, Jerome Powell's Federal Reserve, of being a little too heavy relying on data. And then the other thing that he has been known to say is that he thinks we should rethink inflation, what he calls dogma, which I think that's accurate. If you think about it, when you look at what the Fed's been doing, of course, we just had a Fed meeting earlier this month in January, and they decided no change in the Fed funds rate. It was left unchanged when, a few months ago, there was a pretty strong prediction it was going to drop by 0.25%. Didn't happen. And I think this new nominee is, in his way of thinking, maybe we're getting a little bit too hung up on inflation, as he calls it, dogma. The target is 2%. We've been running pretty consistently around 2.6, 2.7 for quite a while now. That's a heck of a lot better than when we were at 9% a few years ago, right, during the previous administration. So really, we've come down from over 9, and we're less than a point away from the target of 2. Does that still require being as restrictive as the Fed has been up till now? I think this new nominee would suggest otherwise. And so in that respect, if he ends up getting the job, that could be good for us in terms of the Fed funds rate getting lowered. Again, that's not a direct correlation, but it's part of the overall process of rates trending downward. So and there's some concern politically. I don't want to go there too much, other than to say, yeah, there's some concern that he won't be independent, that he's going to do whatever our president tells him to do. I think that's a little bit overstated. This person looks to be a pretty impressive guy. I'm sure he'll make his own decisions. If it happens to be that he's somewhat aligned with our current president in terms of where rates should be, I don't think that's a bad thing. And of course, our current president is very prone to exaggeration. Do we need a 250 basis point drop in the Fed funds rate? No, that's that's excessive. But nonetheless, I think we could be a little bit better lower than we are now. So there you have it. That's where we're at in terms of the mortgage and bond markets right now. So what we're going to do next is we're going to get into a product spotlight, as we usually do. And what I want to do first is we're going to talk about the Home Safe Second program. That's a reverse mortgage second trust deed program. And before I talk about it, I want to show you this very quick video. It's only about 2 minutes, 40 seconds. So take a look at this.
Introducing Home Safe Second, a second mortgage that doesn't require monthly payments. It's a way to access home equity to improve cash flow without any impact on your current mortgage. Here's how it works. If you're a qualified homeowner age 55 and up, Home Safe Second can loan you a lump sum of cash based on factors like your age and your current amount of home equity. Unlike a traditional home equity loan or a HELOC, you're not required to make monthly payments. So instead of spreading out payments over a 10 or 20-year term, you pay back the loan and its accrued interest at the end, when you no longer live in the home. Home Safe Second is a unique and groundbreaking financial solution for those looking to weather economic uncertainty by offering greater benefits than a traditional HELOC. Let's take a look at why it may be right for you. Meet Susan. Susan took advantage of previously low rates to refinance her mortgage and solidify her monthly budget. But then inflation hit, and her monthly costs have grown out of control. Susan struggles to make her monthly budget, but her day-to-day costs are more expensive, everything from groceries to gas. She needs extra cash, but doesn't want to refinance her low-rate first mortgage. She could put her expenses on a credit card, but the rates could be extremely high and they require a monthly payment. The same thing goes for personal loans. And though a home equity loan like a HELOC has a more favorable rate, its required monthly payment would cut into the cash she needs. This is why Susan chose Home Safe Second. With a fixed rate, no additional monthly payments required, and no change to her first mortgage, Home Safe Second loans Susan a portion of her home equity, making her retirement budget more comfortable and putting her worries at ease. When Susan leaves the home, she or her heirs will be responsible for paying back the loan, which can be settled with the sale of the house, but will never amount to more than the home's value. Whether you want to cover rising costs like Susan, consolidate high-interest credit card debt, fund medical expenses, pay for home improvements, and more, Home Safe Second is a helpful solution for improving cash flow and reducing financial stress. Contact a home equity specialist today to learn more about how Home Safe Second can put you first.
The basic idea was profiling a homeowner where she meets the eligibility requirement of being over 55, but running into some issues financially in terms of the high cost of living these days. And of course, it explored the idea of what alternatives would a person like that have in terms of, getting more funds available to deal with the various aspects of the high cost of living right now, whether it be, increased cost of gas and groceries, improvements that need to be done to the home and so forth. So let me go ahead and show you a slide that I have where I'm going to just cover the bullet points of why this Home Safe Second program can be a really terrific program for you to consider if you're a 55 plus homeowner and you're running into some obstacles in terms of tapping into your equity when you need some funds for a variety of reasons. As you can see there, the slide says Home Safe Second. It's a little clever. Give your budget a second to breathe. Again, this is a second mortgage. So the idea here is, what can you use this for? Let me show you the bullet points. First of all, and I'm seeing a lot of this, people are over 55. They still have income, but maybe it's been reduced from what it used to be before. And they're, unfortunately, I'm seeing a fair amount of homeowners who have got quite a bit of credit card debt, and they're struggling on ways to get rid of that and reduce that very high interest cost. So this is a primary reason why this Home Safe Second can be beneficial to that type of homeowner. And of course, the next one, I mentioned it already, cover the rising costs at the pump and the grocery store. Although, frankly, more recently, we're seeing improvement in both of those costs. Gas prices are down. I think grocery store prices are down. Heck, I bought two 18 2 cartons of 18 eggs, 2 of them for less than $6 at the market. So the old egg prices are too high thing seems to have subsided somewhat. The other big area where I think homeowners over 55 can end up struggling financially is funding long-term care, medical expenses, or just if they have an unforeseen emergency. A lot of homeowners, especially as you get into the older homeowners, not everyone has got a real good safety net in terms of savings to tap into. And if they have a lot of equity, it can be frustrating to figure out a way to access that. And then the next thing most common that we see is paying for home improvements. I'm talking to a homeowner now who meets the criteria in terms of being over 55. In fact, they're in the mid to high 60s, and they've got some issues. They got a lot of equity, like $800,000 worth of equity, but they need a new roof. They need their bathroom redone. They need some other things done to the home, and they are lacking the financial wherewithal to take care of that. They've got a low rate first mortgage, so they don't want to just refinance that. Plus the fact when they looked into getting a home equity line of credit, they didn't qualify, because those are actually pretty difficult to qualify for based on meeting a debt ratio. So why would the Home Safe Second be a good alternative for them? Well, first thing to know is you're not going to have any mortgage payments required. I want to underscore required. You can make payments on this loan if you want to, but it's a reverse mortgage type of a product. And even though it's a second mortgage, that means once you get the funds, you do not have to make payments unless you want to. And of course, why would you do that? Maybe because you want to avoid the interest costs being added to the balance and have that balance grow over time. When do you pay off the loan? You do have to pay it when you leave the home, just like a first mortgage, reverse mortgage. That usually means either because you've passed away, or in some cases because you have to exit the home and maybe go into long-term care. If that situation occurs and you're going to be out of the home for more than 12 months, that's considered leaving the home, and then you or your heirs are going to have to get this loan paid off. That doesn't mean you have to sell the home, but it does mean you have to figure out how to pay it off. You could keep the home and refinance it, if not yourself, your heirs, or you could sell the home. It's really going to be up to the family to decide what's the best way to repay this loan, whether you keep the home or not. Keep in mind, the loan balance, of course, will grow over time if you don't make payments. That's because the interest accrues back to the balance, just like a first mortgage, reverse mortgage. But you or your heirs will never be liable for more than what the home value is. So if you get one of these loans and you keep it for many years, to the point where maybe the home appreciation doesn't keep up with the growth of the second mortgage balance, and you end up in a situation, what we call underwater on value, not to worry. If you exit the home because you've passed away, your heirs are not going to be responsible for that negative balance. That is absorbed by the lender. It will not be absorbed by you or your heirs. And this loan is much easier to qualify for. You do have to have a 640 credit score, and you don't qualify based on the typical, debt to income ratio. So for that perspective, if you meet the credit score requirement, you got a lot of equity, you're over 55, you're running into trouble getting qualified, whether it's a cash out refi, or you have a first mortgage that's at 2 3/4, 3%, you don't want to touch it, but you can't get a HELOC because you're told you don't qualify. This is a great alternative. I would encourage anyone or if you are in this situation yourself, give me a call. I'd be happy to give you some numbers and show you how this can be very effective to address your financial concerns and get you a lot better place financially in terms of cash flow and money needed to cover any of these expenses we just discussed. So with that, we're going to go ahead and talk about actually a couple of articles that I had an opportunity to read this week, and I found them a little bit interesting in a variety of ways. So I want to kind of go over this because both of these articles kind of talk about some things that we've talked about a lot on this show, and I got a little bit of chuckle on these because of what was described, what was asserted in terms of having a mortgage, or in the other subject we're going to talk about in a minute here is incentives from home builders and from sellers. So the first article, it was actually in Business Insider, and it was interesting because the headline caught my attention. Of course, again, beware the headline. So I wanted to read the article. It said, I'm trapped now because of 2.75%. And I thought that was interesting to hear that. Of course, we've heard that a lot, that part of the reason we have the housing market issues we do is because so many homeowners are locked into a very low rate, and they feel like, as the slide shows, that they're trapped and that they can't get out. So that's what we want to talk about a little bit, because I have a few things to say about whether or not that's really true. And so here we got the slide where we're going to go ahead and cover some of these bullet points. One of the things about this article that I thought was interesting, it described a young couple in Cincinnati. They bought a home during the pandemic, and they loved their home. And they described all the neat things about it. It sounded like it was an older home, had a great view of the city, within walking distance of services, restaurants, etc. They loved the sort of the old-fashioned wood floors and wood windows, and the used older brick. So of course it's very quote unquote charming. But what they were starting to realize is maybe the home didn't meet their needs anymore. Describes some interesting things like there's no garage. They have to park on the street, sometimes a quarter mile away. There's 34 steps, concrete stairway just to get up to that, and then 10 more steps to get to their front door. That's 44 steps. And of course, how is that an issue? Well, hauling your groceries up all those steps, potential for injury from all those steps. And again, I've already mentioned the lack of parking and so forth. So you have to realize it. And so it dawns on them as they get older, the characteristics of the house could prove to be a challenge for them, like going up that many steps when you're in your 50s or 60s. So as the bullet point points out, they have to evaluate, anyone in this situation, you have to evaluate the real reasons for why you want to move. You have to consider the quality of life, as it says here, trumps the interest rate math. And there's a couple of ways you can do that. One is you could look at leveraging your equity. Now, if you look at it from that perspective, chances are they bought this home in 2020. So I'm sure that the value of that home has gone up substantially, because after all, we all know home prices have gone up by literally 50% since 2019. So one of their options would be to stay put and tap into their equity to do some improvements, maybe to address some of these deficiencies that this current home has for them. The other thing they could consider doing is tap into the equity for a down payment on the next property that they do express interest in pursuing. And why would they do that? Well, as the next bullet point points out, they could rent out their current home, pull some equity out for your down payment, then rent out this current home. And in most cities, I'm sure Cincinnati is the same, many cities have pretty strong rental markets. And this can allow a homeowner to potentially cover their existing mortgage, maybe even have some positive cash flow, and allow them to relocate elsewhere. And that may be true even if they have that existing 2.75 mortgage and they do pull some equity out, depending on the city, and Cincinnati may be one of them. They could do that, rent out the home, and then be able to cover all their mortgage debt payments, or at least a very high percentage of those mortgage payment debts, so they can comfortably move on to the next property. The other thing to do, and this is where I find it kind of interesting, this person had mentioned, the husband, that he was a certified education or financial education instructor. So one of the things he pointed out as a reason why they are quote unquote trapped is he looked at how much interest cost are they going to incur over the 30-year term of their existing 2.75 mortgage. And what would be the interest cost if they went ahead and sold this home and got a 6% mortgage? And of course, the difference is substantial, right? The interest cost at 6% is more than double the cost at 2.75 over a 30-year term. But it's interesting that a certified financial education instructor would point that out as a reason that they're trapped. As you know, I've said on this program more than once, I don't think evaluating total interest paid on your existing mortgage or the new mortgage you might get, even with the rate differential, is very relevant in terms of making decisions like this. And I say that because the probabilities are you're very unlikely to keep this mortgage, even the current one they have at that very low rate, or the one they have to get if they buy another home. You're very unlikely to keep that loan to term. So looking at how much interest is paid over that 30-year term with either rate really just is not that instructive. And so I found that to be a kind of a faulty premise for them to consider that they're trapped and have no way out. And so then you have to say, well, what can you do given that notion that they feel like they're trapped? I would say, as we talk about on this program many times, explore creative financing options and loan options. Number one, as we just put on the screen here, you could, remember I said pull some equity out and buy another home, rent out your current one. Well, in doing that, look for a home where you can assume the mortgage, FHA, VA. There's lots of FHA, VA loans made in the 2 to 3% range during the pandemic. Well, why wouldn't you not be trapped? Pull some equity out for a down payment. Remember, FHA only requires 3.5% down, and then use that equity that you've pulled out for that down payment and look for an assumable loan. Now, of course, if it's an assumable FHA loan, you're probably going to have to put more than 3.5% down because that property, if it was acquired, that loan was made during the pandemic era, it's probably gone up in value. But you can still maybe potentially assume a 2-3% mortgage. And if you don't have all the cash to cover the difference between the purchase price and the existing assumable mortgage, you can get secondary financing to bridge that gap. And then, of course, the other thing, we talk about this all the time on the program, consider using or getting seller concessions to do interest rate buy downs, and then maybe have some additional credit left over to cover your closing costs. And so, of course, the other thing you could do is consider rent before you buy. Again, you could pull equity out. One of the things that this article pointed out, this young couple, is that they are interested now in moving farther away from the city, getting something that has, more of a yard, that does have a garage. They'll give up that nice city view. They get rid of those 44 steps to get to their front door. And in that respect, be able to have, a quieter, more, I guess, maybe more suburbs, rural area. And then be able to get maybe a newer home, a home built more recently, that will not have some of the improvement issues that an older home like they're in now might have to do. And of course, in making that change, you might consider rent before you buy, figure out where you think you want to move to, maybe rent first, kind of evaluate the area and make sure you're comfortable so that you don't make the same mistake they made in 2020 and buy either a property and or in an area that maybe with some afterthought, they might realize wasn't the best choice. And then finally, be patient. These folks feel like they're trapped. They may never leave because of the interest rate. But in fact, it kind of makes me think about, we've talked before. Remember the old adage of marry the home and date the interest rate? Well, these folks really, in a way, what they've done is they think they married the home, and they for sure think they've married the rate. And if you thought you married the home and you surely feel that you've married your interest rate, what you really need to do now is divorce your home, which is kind of a flip of where the adage normally says, marry the home, date the rate. In this case, they want to divorce their home. And of course, in doing that, they're going to give up the rate. So I guess as a consequence, they're going to have to divorce their current rate too. But in long term, they may be better off. And the other thing they mentioned is that in buying another home, they might downsize a little bit. So in that respect, what you do is you look for that other home. You consider the fact that most home prices do sell for some percentage below the actual list price. Determine what that average is in the market you're looking to buy in, and then use that data and get with a professional realtor who can help you negotiate concessions so that you can get those concessions not in a lower price, but in dollars, and then apply that towards your financing so that you can at least address your feeling of being trapped at 2.75. Get a temporary buy down, 3-2-1, where at least the first year you could potentially, you can see on our rate grid, you can get a 3-2-1 buy down at 2 7/8 first year. That's awfully close to the 275 that they feel like they're trapped in now. And with the 3-2-1, they've got a 3-year window for overall rates to fall and be in a position to refi and have a better, lower long-term mortgage after they do that refi. So interesting article. I feel like these folks, I wish I could talk to these people. If I could do loans in Cincinnati, I would reach out to these folks and show them, hey, you don't have to feel trapped. There are solutions here. Let me help you figure out creative ways to address all your concerns and get you in a better place in terms of home ownership, and maybe actually find the home that you will marry. And of course, yeah, you're going to date the interest rate. Again, it's going to be higher, maybe in the high fives is where we're at. But that, again, still puts you, I think, in a pretty good position that if you get some incentives with that, or maybe that high 5 rate can be down at low 5s or 5 or even 4 7/8, and then you're in better position longer term where you're dating that still higher rate, but better than what you think it is, and then have the opportunity to refi when rates do fall. Remember, 30-year mortgage is a one-sided bet. Locks in your ceiling, and then you have that opportunity to refi into a lower rate when the opportunity presents itself. So interesting article. I think it definitely overstates the notion that you're going to be trapped by a 2.75 rate. It's my desire to try to educate as many homeowners as I can that no, you don't have to feel trapped, and there are ways to get out of that trap and get yourself in a better position long term for housing that really is going to serve your needs better and for longer. So with that, we're going to go into this other article. This is out of a trade publication that I get. It's common in the mortgage industry. It's called Mortgage Professional America. And boy, did this one catch my eye. Builder incentives need to be made illegal. This is coming from a CEO of a mortgage company. And I thought, wow, that's an interesting take. What does that headline really tell? What is it really telling us? So, of course, I say all the time, beware of the headlines. If you see a headline that gets your attention, don't take it at face value. Jump into that article, read it, find out what's really being said there, excuse me, so you can determine if that headline really matches the reality of what the author is saying when you read the article. So I did that. I read the article, and I'm going to pull up a few things that this person, this CEO, is arguing. Now, there's his name, and you can see the company that he is CEO of. And he says that these incentives are keeping home prices artificially high, thereby inflating existing home prices in the area. Well, I would challenge even that. Again, I said earlier that, like certainly in our market here in the Coachella Valley, the Desert Housing Report for December just came out. And on average in this valley, the ratio of list price to closing price is about 96 to 97%. In other words, homes listed are generally selling at about 3 to 4% discount from their original list price. So in that respect, what does that tell you? Well, what I think it tells you is that, yeah, there may be some room in the list price of homes, and that as a consequence, you may have an opportunity to get some concession. But excuse me, does that mean that those prices are artificially high? I would think not. And of course, his next point, he says, because he thinks that these home prices are artificially high, he thinks the practice needs to be made illegal. And again, what he's talking about here, by the way, is home builders. He's specifically arguing that home builders' practice of offering incentive to sell their homes should be illegal. I mean, wow, what a statement to make. And of course, you see it right there, because he says what they're doing is they're inflating the purchase price to give the same money back to buy down the rates. Okay. They're inflating the price to buy down the rates. Well, presumably, as I've talked on this show many times, if you're going to get a concession to buy down your rate, you're going to find that financially, you're going to have a much more affordable mortgage. And then if you get that same concession from a lower price. I mean, I've demonstrated that on this program multiple times. So again, it's very odd for a CEO of a mortgage company to come to that conclusion. And let me give you, excuse me, a little bit of historical background as it relates to seller incentives. When I get in the business many years ago, and this is back in the very early 80s, there was no limits to seller incentives to buy a home or to sell a home. None. I can remember in the early 1982 era that, again, rates were in the 17, 18% range. There were new homes being sold where the builder was offering a below market rate, like from 18 to 12. And they were paying like 15 points to offer that below market financing. The purpose? To get more buyers qualified for their home. And how did they account for that very high amount of credit or concession? Yes, they put it into the price. That practice was excessive. And it wasn't too many years after that the industry recognized that that was a problem, because at the time, those very high incentive amounts were being added to the price. And when the home was appraised, the appraisers were not taking into account that very high amount of incentives in establishing the value of the home. Well, it became pretty evident not too many years after that was, yes, those homes were inflated in value, and there were problems associated with the fact that eventually that came home to roost, and people were in situations where the home really truly was not worth what they thought it was because of the inflation in the price. So the point of that historical context is, to the extent this practice had to be made, if not outright illegal, but at least restrained or cut back, the industry took steps to do that. The current interested party contribution limits, that's what they're called technically, have been in place now for several decades. Conforming loans, Fannie Mae, Freddie Mac. It's the 3-6-9 rule. If you put 5% down, less than 10% down actually, a seller credit is available, but only 3% of the price. If you put at least 10% down, but less than 25% down, the seller credit allowed is up to 6% of the price. And if you put 25% down, it's 9% of the price. If you put 25% down. So again, those are more reasonable concession limits that have been in the industry for years. And appraisers now do take that into account when they're appraising the value of the home. And if you noticed, especially on the 3% edge of that 3% edge of that range, that's consistent with homes typically selling at 96, 97% of the list price. That's not coincidental. So that is another clue, another data point to tell you that you can use the price of the home to finance some incentives that will directly address the affordability of your mortgage. I'm going to show you a few other data points here. According to the National Association of Home Builders, in its latest survey, latest index, 65% of home builders use sales incentives. 10th month in a row above 60%. Again, this has been going on for decades. I used to meet with home builders in the Antelope Valley in Northeast LA County in the late 80s. And we would meet and talk about what kind of incentives could the builder offer to help address, even then, the financing offered to the borrowers so more borrowers can qualify. So again, this is not a new practice. And now, part of why this CEO points out that the practice should be illegal is, yes, more home builders, as the next bullet point shows, 40% were cutting their prices in January. That was the third consecutive month that number had been at or above 40%. And then he goes on to, interestingly, basically make some quotes from Lennar Homes. Well, if you remember a few months ago, I brought up Lennar Homes and because they had issued a press release to talk about their quarterly performance. And in that, what they did, or at least what the CEO believed Lennar had said, was, we're not going to help you finance anything. We're going to drop the price by $20,000 to $40,000. Please buy the house. That's the key. They they were one of the smart ones, according to the CEO, that Lennar was one of the smart ones. And then he goes on to say, one big factor that we all know is that incomes haven't kept up with house prices. Well, yeah, that's not new information. We all know that it's not easy to raise somebody's income from 80 to 120,000 just because we want it to go up. How about the industry bring some of this cost down so we can meet at a level where more home buyers qualify for the purchase? Interesting comment. Well, yeah, okay. Again, I've said before, I've pointed out more than once, I've demonstrated more than once, you could lower a price of a home by 20,000, or you can take that 20,000, don't lower the price of the home, use it towards your loan to create a more affordable rate, more affordable payment, and also more affordable cash to close if there's enough cash left over from that concession in a seller credit to cover some or all your closing costs. And I've demonstrated more than once that scenario is going to give you better numbers, fundamental bottom line numbers, payment, cash to close, than just lowering the price of the home. Why the CEO thinks that somehow lowering the price of the home with no incentives at all, where you're taking a market rate and you're paying all your closing costs, means it's more affordable for our current buyers out there, as the saying goes, I would beg to differ. And he goes on to say, and I think part of his issue is he's a little bit frustrated with the idea that home builders are, getting beyond their specialty of just building homes. Like, they shouldn't be involved in providing incentives. They shouldn't be involved in title insurance. They shouldn't be involved in mortgages. Let's see what else. Because his costs are so high, I have to bump up everything. That makes it unaffordable. But if I just focus on one line of business, which is home building, or insurance, or title, or my mortgage, and stay out of everything else, that'll keep my costs low and pass on the benefits to the home buyer. Yeah, well, yeah, maybe. But one of the key points that he forgets, or he doesn't mention when he brings up Lennar as his example of home builders that have slashed prices, is, did Lennar say we slashed prices and we stopped offering incentives? Well, no, go back and look. What they said was, yeah, we reduced prices aggressively because we had a lot of inventory. We needed to move it. But they didn't say they eliminated incentives. They admitted they were still offering them. So how did that squirt out in terms of their financial performance as a company? They acknowledged and they showed that what got compressed was their profit margin. So what the builder was doing, Lennar as the example, they're the big 800-pound gorilla in the home building industry, at least as it relates to, homes for first-time home buyers and move-up buyers, not luxury homes. What they did is admitted that we had a lot of inventory. We needed to get that inventory moved, so we lowered our prices, but we still offered the incentives. So we were willing to take the hit on our gross margins. So they were willing to make less money to address the affordability issue by lowering their prices, but they still offered the incentives. So, of course, what did that do? It moved their inventory very quickly. So it proved to be a winner, at least as it relates to what this CEO is concerned about, making homes more affordable for more buyers. Lennar accomplished that, and they were willing, as a trade-off, to accept lower profit margins to get more homes sold. So I think, as it relates to this particular CEO's perspective, and he's certainly entitled to have this perspective, I would strongly disagree. I think that incentives are still a very vital part of the market. In fact, as you know, if you've watched the show before, I argue we need to see more on the resale side. More private sellers of resale homes should take a page out of the book of home builders and offer incentives. And in this respect, one of the things that's still going on is a lot of agents will say sellers are not being realistic about their price. They're pricing their homes too high. Well, I would argue, yeah, maybe look at the price adjustment a little bit, but instead of just, cutting $40,000 off your price, find a middle ground. Get with somebody like us, and I'll show you how you can adjust your price, maybe a little bit, but then offer a certain amount of incentives, a credit from the seller, and then show them how that credit can help their prospective buyers get that much more affordable financing, that much more affordable loan, lower rate, lower payment, covering their cash to close, so the amount of cash they need to buy will be lower as well. That's the winning strategy. Home builders have shown that for decades. The resale markets need to do more of that. The issue of, are incentives too high? Are they overly inflating the homes? I would argue that the current arena in terms of limits on seller concessions, 3.69 on conventional loans, 6% on FHA, 4% on FHA, those are reasonable. They work very well. They've been in the industry for years. And so I don't see any need to mess with those limits or reduce them further, or certainly not illegal, make them illegal and eliminate them altogether. I think that on balance will cause more injury to the housing market. It's certainly not going to help. So with this particular CEO, I have a different opinion. Of course, we'll see how all that plays out. But I kind of feel like, based on what I've been doing in terms of the loans we originate, I think that's a winning strategy. And I think that could be for you if you're trying to sell a home. And it can be for you if you're looking to buy your home, especially your first one. So with that, we're going to go ahead and conclude this week's Mortgage Minute. I do want to point out, by the way, don't forget, we talked about this a couple weeks ago. The California Housing Finance Agency Dream for All program is coming. The starting date to get pre-qualified and get registered for a voucher is February 24th. So if you're a first-time home buyer, you've been on the fence about buying, this is a great opportunity to get up to $150,000 for a down payment from the agency, California Housing Finance Agency. That means you can buy a $750,000 home and get the down payment, the 20% down payment from this agency. So again, February 24th, it's right around the corner. Get with us. We can get you pre-qualified, get you in there to get a voucher. And then, hopefully you'll be successful once they do the random drawing to get those vouchers allocated with funds to buy a home. So don't forget that. Call me if you want more details. So with that, we'll conclude the Mortgage Minute for this week. I'm Art Alvarez with MortgageWorks, where we have the answers and they're on the house. Enjoy the weekend, Super Bowl, go Seattle, and of course the Winter Olympics. And then I'll see you again next week. So long. Take care.